Welcome to the First Home Show podcast, created for first home buyers. I'm your host, Melissa Barlas. I'm a property lawyer, owner and founder of Conveyed, and I've been a first home buyer myself. In this podcast, I'm going to show you in up to 10 short-minute increments what you need to know as a first home buyer, and I'll share with you all of my legal tips on how to purchase your first home successfully. Don't go it alone in the property market. We at Conveyed are here for you. Hello to our listener. Welcome to the First Home Show. I am your podcast host, Melissa Barlas. I'm the owner and director of Conveyed. We're a conveyancing law firm servicing Victoria and Queensland, and soon South Australia, WA, and New South Wales. Almost forgot. So that's me, and I have a fantastic guest today for you. His name is Mike Mortlock. And Mike has a very impressive track history. He's the director of MCG Quantity Surveyors, but he's also impressively a board member on PIPA, and PIPA stands for the Property Investment Professionals of Australia. If you're a property professional yourself, you would have heard of that association. So Mike is doing some very cool things in the property space. So welcome, Mike, to the podcast.
Thank you very much. It's a pleasure.
Very good. All right. So today I wanted to touch on something that we don't really talk about a lot. I don't hear it a lot in many videos or podcasts. So it'd be nice to touch on it. And it's especially important for people that may be first-time investors that don't know much about this space. But I wanted to talk about the sexy subject of depreciation schedules and get your insight into what is a depreciation schedule for anyone, for our listener, if they're interested in investing, if they're the first time even going into a market and toying up, if they want to buy a home or an investment. What is a depreciation schedule, and what's the benefit of that to someone going in and investing for the first time?
Yeah, great questions. And I think it's important to remember that the investor stats that we're seeing at the moment aren't kind of what you would think traditionally. The majority cohort of investors are in their 20s and 30s, and some of that will be rent vesting. So it is quite relevant for young people as well as old crusty ones like myself. But a tax depreciation schedule is essentially a report. The easiest way to think about it is think about, say, a property valuer. They go to the property, they take some photos and some notes, and they go back to the office and they give you a market value. Our report is not a market value. To us, land has no value, us quantity surveyors, right? Because when it comes to depreciation, you can only claim the value of the built structure. So what we do is we estimate the cost to build the property when it was built. We estimate the value of any improvements or additions or renovations. And essentially, we give you a report that says, this is the amount that you can claim as a tax deduction each financial year, and the report lasts for 40 years. So probably the easiest way to think about it is if, let's say you're on $100,000 and we do a depreciation schedule that gives you $11,000 back, then in the eyes of the tax office for that financial year, you're only earning $89,000. And the difference in tax you'd pay, it's high 23,000, so just under 24 grand you would pay as an investor on 100 grand. But with that depreciation schedule, it's closer to 20. So it's actually around about that sort of 3,500 mark that you would get back in your pocket just in that first year alone.
Wow. And that's just from depreciation, using depreciation schedule. Wow, that's fantastic. And so would you say you'd get more back then from investing in something that's newer versus something that's older?
You could say that as a generalization. I don't like to say that because I'm a self-confessed data nerd, right? So I've seen examples where that's not true. But yes, in a broad sense, newer is better. So if you buy a brand new property, you're able to claim the building structure and all of the plant and equipment items like carpets and blinds and kitchen appliances. If you buy a place that's 6 months old, for example, you'll only get the structure. So you won't be able to claim the carpets and the blinds and the air conditioning and those sorts of things. But why I sort of was kind of twitching at the question a little bit is because say, for example, you have a project home that's 350 grand to build and it's brand new. There'll be some great deductions in that. You might be thinking 15 or 16,000. But what about a blue chip property in, say, Melbourne, in one of the nicer suburbs that has had a $2 million renovation on it, but it was built in the 1930s? Well, that's going to give you way more deductions than that brand new one. It's a little bit of a sort of extreme scenario for an average investor, but it can certainly be the case where the tables are actually turned.
Yeah, so it sounds like there's a few variables involved when it comes to how much you may be able to claim back. Well,
that's good, right? Because it'll stop AI taking my job, hopefully.
I hope that's the case. I really do.
Me too.
No, that's really good. So there you go. So yeah, I guess the key benefit is you do get a tax deduction. Depreciation is a way of getting a tax deduction, and very insightful insights from you on that. So thank you very much. I know. I reckon we've got a bit of time. I want to move on to another question that we were chatting about before we started recording today's episode, which was about insurance, because you're also a construction cost specialist, you and your team. Mm-hmm. And so I wanted to gauge from you, when it comes to insuring a property, how can people ensure that they are adequately insured, that their properties are adequately insured? And why is that important?
Yeah, look, there's only one way to do it in a guaranteed sense, and that is to engage a quantity surveyor to prepare a report that says this is what the cost would be to rebuild that property. And what people don't understand from a rebuild point of view is it's not just you look around at your house and you think, oh, it's all right, but here's an ad for XYZ home builders, and they're selling that for 400,000. You think that's way better than mine. Then, I'll just insure myself for 400,000 and I'll get that. Well, it's not actually that simple, because what often happens is that the property might be destroyed, but it doesn't leave a clear, flat, level block, right? So there's demolition costs. There's price escalations over the time it takes from actually demolition to building the properties. There's preliminaries and consultants' fees. So there's quite a lot more to it than just a rebuild cost. So the solutions that are out there for people is that they might ask someone like yourself, or, even a valuer might do this, but valuers aren't, in my view, qualified, because we're not qualified to provide market values, and they're not construction cost estimating specialists. So outside of that, you've got the online calculators, and we've completed a lot of analysis on them, and the breadth of differences between them, where we've plugged in real projects where we have all of the cost information. We've reported huge variances. So some of them are basically just over because your premiums will be higher if you're insured for too much. But if you're underinsured, there's an extra risk as well, because there are things like the co-insurance clause. So if you are you're only insuring, say, 80% of the value, then the insurer will come to you and say, well, you've elected to underinsure your property, so we're going to only give you 80% of the amount you insured it for. So it's even worse. And I think that the most horrific thing is that someone suffers a loss like this, and then they get tapped on the shoulder by the insurance company or a bank or a builder to say, look, you've actually got quite a big shortfall and you won't be able to build this property without chipping back into your pocket. And that's something that we're passionate about trying to stop.
Amazing. So is it fair to say then that there's a lot more people out there that have underinsured themselves as opposed to adequately insuring themselves for their properties?
Yeah, pre-COVID, the Insurance Council of Australia said that 83% of property owners were underinsured. Now, that's already a big number and doesn't account for the fact that construction costs really soared during COVID. So, we're talking in 2021, just over 11% growth. 2022 is 8% growth. So, we're talking 20% increase in prices since that stat came out. So we haven't seen an update on that, but obviously it kind of leads us to the point that it's probably going to be worse than that.
Oh, crazy. I didn't even know that. That's astonishing statistics. So it just goes to show it's really important you get someone like Mike or his team from MCG Quantity Surveyors. They can, make an assessment of what the real cost would be. for the property if, there was an insurable event that took place. And there's a few other costs that we don't take into account that we should be taking into account, like you say, the prelims, the demolition costs. If you were to give us just a very broad sort of breakdown of what those additional costs are that we need to be taking into account, can you give us an idea of that so that people can have it on top of mind to make sure they get the right assessment done by, let's say, your team?
Yeah, it's a hard thing for the consumer to estimate, and we're empathetic of that. I think in the commercial space, it's easy because most people have a commercial insurance broker and they will engage someone like us to make sure that it's fit for purpose. But in the residential space, there's no one really kind of advocating for you, going sort of direct to the insurance company, like, people going direct to the bank to get a loan. That kind of doesn't happen anymore because people use brokers, right? But you've touched on most of them. So if you think about the property being destroyed, you need to think about, well, what needs to happen for that to be rebuilt? There's a period of time that it takes to go to tender to builders and actually get the construction done. And there's cost inflations over that time frame. Demolitions, of course, the big one. And, the construction cost itself might not actually be suitable because what was built on site might not actually be passable with the current government legislation in your local government area. So there might actually need to be some design changes to make sure that that's fit for the streetscape, or it's not too close to the boundary such as it was before. So there's all sorts of little hidden things in there that people wouldn't necessarily understand.
Yeah, it's no, absolutely not. It's enlightening me even just having this conversation with you, because I didn't even know that those additional costs. I didn't even think of those additional costs when it comes to insurance. Now I'm thinking about my insurance and going, I need to speak to Mike and work out, am I paying too much to my insurer? So whenever you're, for our listener, if you're looking to buy a property, really think about that. Think about really gaining an understanding through someone, through a business like MCG Quantity Surveyors, to understand how much insurance should I be taking out on this property, so that if there's an insurable event like a storm or something, or a fire, that I'm not left significantly out of pocket. Because insurers aren't going to go out of their way to tell you. let me tell you that. They're not going to go out of their way. So this is really great. Thank you so much, Mike, for your input about adequate insurance, as well as depreciation schedules. I really appreciate your time.
My pleasure. Thanks for having me.
Thank you. And how can our listener reach out to you, Mike?
Yeah, so you can go to our website, which is MCG QS for Quantity Surveyors, and MCG. I mean, you're a Victorian, you think of the cricket ground, that's the easiest one. You can also find me on Facebook and LinkedIn, and I apologise advance. Once you sort of get into my net, I'm going to pound you with data and insights, because I get very, very excited about construction and tax and the overall property market.
You know what? So do I. So I don't think it's necessarily a bad thing, because knowledge is power.
Good.
So thank you, Mike Mortlock. And if you need to reach out to myself, my website is www.conveyed.com.au. You're welcome to leave an inquiry. Happy to help you out with all your conveyancing needs. And thank you, Mike, for your time.
Thanks very much.
Fantastic. And to our listener, thank you for your time again, for supporting our podcast. I wish you the best of luck with your property journey. Take care and happy house hunting.